Hello again, and welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking concept practitioner, and today I'd like to talk to you about the different dividend election options that you have as the owner of a dividend paying whole life insurance policy. What does that all mean? There's lots of other videos on the channel to get you familiar with the basics of whole life, what the dividends are, all of those details. Today, I'm just taking for granted that you're familiar, at least on a surface level, with these ideas. So, what we're talking about, just in a very brief sense, when we're talking about the dividend on a whole life insurance policy, is your share of the profitability of the insurance company. Now, if this is a mutually owned life insurance company, you are a mutual owner. You are a partial owner of the insurance company by owning this policy. So, if the company is profitable, and many of these companies have 100 plus year histories of consecutive dividends, but of course, they're not guaranteed. The company does have to turn a profit to pay a dividend. But when you receive the dividend, there's a number of ways it can be paid out. We're going to go through each of those one by one and discuss the pros and cons of each choice. The first dividend option, and this is by far the most common thing you will see when you're looking at content online, especially when it comes to infinite banking. When people are talking about infinite banking, they're generally talking about you, the consumer, buying paid up additional insurance, or PUAs as it's commonly abbreviated, but then also your policy, as it earns a dividend, also buys additional PUAs. So what's happening is the dividend is declared. Let's say the dividend is $500. The dividend is then automatically used to buy more whole life death benefit or paid up permanent death benefit. The effect of that is that in one single payment, your death benefit has been permanently increased on the policy. In other words, the insurance company cannot come back to you later and take back the dividend or reduce your insurance because they feel like it. It's not an option. You're the owner. You're the first owner, even before the insurance company itself. You have this contract. You've got a death benefit. You're going to ratchet that death benefit up by buying more death benefit. As a consequence of that, two things happen. Number one, you have a larger pool or ownership stake in the company. Think of like a stock in the stock market. You own more stock, if you want to think of it that way. And that makes you eligible for a larger dividend next time. If the dividend rate is the same year after year, but you own more death benefit year after year, you are then eligible for more dividend, more not as a percentage, but as a total. The volume of dividend you'll receive would be increasing over time if the dividend rate was the same year over year. The other consequence of that, because this insurance is paid in one payment, is that your cash value in the policy increases significantly. So again, if you have a $500 dividend or $1,000 dividend, your cash value might increase by $500 or $1,000. Or depending on how the contract works, it may be slightly less than that. And it also depends on how much insurance that dividend can purchase, because what you want is more death benefit. But there's sometimes this sentiment online that you want the least amount of death benefit with the highest cash value. That doesn't even make sense, because the cash value on a life insurance policy is the present discounted value of the death benefit. You must have more death benefit in order to have more cash value. They are the same thing expressed in two different ways. That's a sidebar. Let's move on. The next dividend option you have as an owner is to accumulate your dividends at interest. That may sound like the same thing as our first option on the list here, but it's quite different. When your policy accumulates dividends at interest, what's happening is that your dividend is paid into what is basically a savings account, and it sits in this account and earns interest, which is taxable to you when you receive it. But it's going to be basically a savings account. There's nothing exciting or different about this. It's just a separate account, not in your policy, that is going to accumulate at interest. Typically, the interest rate on these are very low. You might see 1%, you might see half of 1%, you might see even lower than that. And so this is something that's really not done. I have not ever had any client do this, even for a short period of time, because there's just not really a reason to do it, in my opinion. It's not to say that I won't ever see a situation where someone will use this option, but it's certainly not popular. It's there, you should be aware of it, but not something that I would choose in any normal circumstance. The next option is to have your dividend reduce your premium. So let's say, for example, you have a $2,000 annual premium on your whole life insurance policy, and your dividend for the year is $1,000. Okay, you can have that $1,000 reduce the premium so that your out of pocket expense is $1,000 instead of $2,000. Now, do you know exactly what your dividend is going to be prior to your policy anniversary? No. So, what's going to happen is that your dividend will be applied, and then you would find out from the insurance company or from your agent what is the remaining balance due on your policy for that year. Once you've had a policy in force, particularly if you are doing a more IBC style policy, there may be a point at which your dividend completely pays your premium, or it may be a dividend that's multiple times the size of your premium. However, your agent is not allowed to call this free life insurance. Much the same reason that we cannot promise a dividend. We do not know if a company will be profitable or to what extent they will be profitable in advance. We can't know the future, neither can you. So don't think of it as free life insurance. Just think of it as an excellent fallback plan to reduce or potentially eliminate your due premiums if you want. That's a great option if you're in a financially difficult period of your life. But just remember, if it's doing this, it's not accumulating more paid up additions. It's not building the cash value. It's not increasing the death benefit. It's either or. So be aware that it does have impacts. You may want to ask your agent for an in-force illustration before you make a decision to switch your dividend election, particularly if it's going to do this and not really focus on building the value. If you created this policy to build value, then you want to know what the impact will be if you switch your dividend election to reduce premiums. Makes your cash flow situation easier, but it may not meet your long-term growth goals if you do this. The fourth dividend option is to have your dividend reduce the loans that you have outstanding against your policy. If you're not familiar with policy loans, we've got other videos on those, but let's say you've taken a $10,000 policy loan against your policy. Great. If you were to not make any payments on that loan and the interest rate was 5%, it's currently a little higher than that as I record this, but let's just say 5% for convenience. That's $500 in interest if you make no payments for an entire year. If you have a dividend coming in that's $500, then that just eliminates the interest. In other words, your policy loan wouldn't grow at all. Your $500 dividend would pay against the principal of the loan, because policy loans are principal first, but then your $500 accrued interest would be added to the principal on your policy anniversary. Okay, so it's more or less a wash. Now, if you have a $1,000 dividend, as we've talked about in some of the other dividend examples, well, you've reduced your loan. Eventually, your dividend might pay off that loan without you having to do anything else. But here again, Just be aware, if it's reducing the interest on policy loans, it's not buying additional paid up insurance. So your existing pool of accessible capital will continue to grow because your policy will grow on a guaranteed basis in cash value on it every single day. However, just be aware you're shifting priorities, you're moving things around, your dividend's going to do something else. So it's not going to look like your original illustration if you make this move. Still, it can be a great way to keep your policy loans from ballooning to a uncomfortable size. And so this is a great option that you may want to use sometimes. The fifth and final dividend option is to receive your dividend as cash, or in other words, the insurance company can send you a check for your dividend. Now, this requires a little bit of further explanation, and be aware I'm not giving tax advice in this situation. I'm not qualified to give tax advice. Be sure to talk about these things with your CPA, but just as general guidance here, you may receive back all that you have paid in to a whole life insurance policy without any taxable event. So let's say you've had the policy for a very long period of time, 15, 20, 30, 40 years, doesn't particularly matter, but you're receiving a healthy dividend and you've paid in quite a bit of premiums over the years. So just to use round numbers, let's say your total spending on this policy is $200,000 over many years. If your dividend is $2,000, then you can receive a check for $2,000. It's tax free. You're going to receive what's called a return of premium. In other words, you paid this previously. The insurance company is just giving you a sort of a refund on some of the premiums you paid quite some time ago. You can continue to do that. You can receive a check. It'll probably be a larger check the next year, $2,100, $2,300. Let's just keep it going. You could do that for years and years and years and just receive an income from your policy without any adverse tax consequences. However, whenever you have recovered all of your outlay, in other words, when you hit that $200,000 mark, then anything beyond that that you receive would be considered taxable income. So do be aware of that. It's more or less once you've gotten to whatever the gain portion is, when you start tapping into that, you may need to think about the tax implications of that, particularly if you're retired and you're really trying to minimize how much income you show on an annual basis for various government benefit programs, etc. That can be a great option, especially if you have been diligently funding your policy over a long period. This can be a sort of a retirement vehicle because you can receive nice dividend checks in this manner. Now, something else, this is not really a dividend conversation, but once you've exhausted that initial cash basis in the policy, it's $200,000 in this case, you can then take policy loans to access your gains. And so then you are loaning against the gain portion, which is again not a taxable event, and that's great. However, you do want to control your interest cost as we discussed earlier. You don't want this to balloon out of control and become a problem later on. If you'd like some individual advice, here I can't give you advice. I'm just talking to the void. I don't know anything about your unique situation. So if you would like actual advice on these topics, please reach out to Perfect Spiral Capital. You can find links to our booking page and speak with one of our agents down in the description box below. We are more than qualified and happy to help you navigate this honestly quite confusing financial tool as you tap into all of the different aspects of it that you may find useful throughout your lifetime. Also, in the description box, you'll find a link to my Amazon best-selling book, Between the Lies: How to Reclaim Your Future from the Banks and Wall Street. It's got a lot more in there than just talking about life insurance. In fact, life insurance doesn't even come up until pretty late in the book. So there's lots of great material in there to help you organize your thoughts prior to reaching out and speaking with one of our agents. Thank you so much for watching, and we'll see you next time.